Hello, Governor Villeroy de Galhau. Good to see you.
Yes.
Thank you very much for doing this, for chairing this session. Now we're going to the center of the questions on strategy. We've heard a lot already this morning, both about the mandate and strategy and what the mandate allows or what it might not allow. We've heard a lot about the instruments in the second session and whether QE was effective and how effective and what the side effects are, and whether we need negative rates or not. So I think it's great to bring this together this afternoon. We are already here. Otmar Issing is here on location, Petra Geraats also, and hello John to California. Great to see you.
Hello.
Let me hand over to Governor Villeroy. Of course, we're watching with a lot of attention what the ECB has been doing. We're excited that we're very supportive of the idea of going forward with the strategy review, and we're very happy to be able to contribute to it. So we're looking forward to what else will happen. So Governor Villeroy, it's to you.
Vielen Dank. As this is our third panel today, let me first thank Volker Wieland and Birgitta Wolf for what has been already a very interesting discussion this morning. If I may, you have shown us that the European economic debate can be much more substantial than, say, an American political one. And allow me three very short personal takeaways from Christine Lagarde's impressive speech and our previous panels this morning. First, on our mandate, it puts a clear priority on price stability, and it is not a dual mandate, obviously. But it is not either a merely single mandate. I would characterize it as a two-tiered mandate. Second, on our inflation objective, being symmetric and medium term, if credibly, I stress the credibly, symmetric and medium term, would probably achieve similar outcomes ex post to flexible average inflation targeting. And third and last comment, rethinking the second pillar and tracking a broader set of variables, including assets of financial institutions and nominal GDP, could help the ECB. It could help to cross-check and to reconcile our so-called secondary objectives, starting with financial stability, with our primary mandate of price stability. Let me now come to this third panel about the crisis that the euro area has faced since the last strategic review 17 years ago, and about the possible lessons for the conduct of our monetary policy. Just to say that we faced three crises: the great financial crisis of 2008 and 9, the European sovereign debt crisis of 2011-12, and obviously the present COVID shock. Central banks, including the ECB, have been fast, have been very innovative, and have been, yes, effective in the answers to these three crises. Only two remarks on the present COVID shock. Obviously, it's too early to draw the lessons, but it is indeed armed with the multiple lessons of the previous crisis that central banks and the ECB have managed to prevent this health and economic crisis from turning into a financial crisis. And here, so far, we have been successful. Let me also add that, contrary to pre-existing fears, central banks did not run last March out of ammunition. And you remember there were many fears about that. On the contrary, central banks, and this is probably a lesson for the future, central banks are by nature never short of ammunition. So there are positive lessons, but there is no room for complacency, and we will discuss that. There are obviously questions. to quote some examples, questions about financial stability and the possible side effects, question about possible exit strategy in the future, and question, as Christine mentioned this morning, about communication with the broad public. I would say that as monetary policy becomes, after this crisis, more sophisticated and more powerful and more central, it also probably is at risk of becoming less understood. So we are fortunate enough to have three very distinguished speakers to put some light on these central issues. I don't need to introduce them, but only to quote the three of them. First and foremost, Professor Otmar Issing, who was, if I may stress it, the mastermind of the ECB last strategic review in 2003. Then Petra Geraats from University of Cambridge, and last but not least, John Teller from California, Stanford University. Can I only remind each of you that you have 15 minutes. I will try, if necessary, to be as efficient in timekeeping than Pablo has been this morning. And I stop here. Professor Issing, lieber Otmar, you have the floor.
Now it works, yeah? Thank you, François. Thank you for the kind words in the introduction. I think the review of a strategy of the ECB has to have a reference point. President Lagarde this morning took the review of the strategy in 2003 as a reference point. One can do that, but I think one has to go back to 1998 because in 2003 there were made minor adjustments in my mind, but 2003 review was a full support, confirmation of the strategy. Christian Noyer has already explained some of our many of our considerations we were at place, and I think talking about the strategy, which goes back to 1998, one has also to consider what might have been due to the special circumstances when the euro started, and what is more permanent in this strategy. May I start with a few personal reminders. At the meeting on 13th of October 1998, I presented what was called a stability-oriented monetary policy strategy, which was adopted by the Governing Council and was made public on the same day. It was probably the first time in history that a new central bank published its strategy before taking over responsibility for its currency 2.5 months later. Just to give you a sense about our discussions, when I presented in this context the proposal that we should understand the mandate of maintaining price stability as an average annual increase in HICP inflation of below 2%, the whole council was against me. And there were 3 camps. The first camp was saying, why should we set a numerical target? This can only create problems when we miss it. The second camp argued, Otmar, you are crazy. This is much too ambitious. Too ambitious because over the 50 years existence of the DM, the annual average inflation rate was 2.8%. So the ECB, new institution, will be more ambitious on price stability than the Bundesbank has achieved. And the third camp said, Otmar, you are crazy. Why? Because at that time, inflation was coming down, approaching 1%. When we started, HICP inflation was 0.8%. So the argument of this camp was, if we announce that we understand price stability is an inflation rate below 2%, we announce quasi that we will do everything to bring up inflation as soon as possible. But it's always good if your adversaries, if I may so, are divided. So finally, as you see from the result, below 2% was accepted. But we made very clear, this is not our mandate, is maintaining price stability. Our understanding, interpretation is below 2%, but this was not a goal, it was an understanding of price stability. And what is extremely important, we stressed that we want to achieve this goal in the medium term, on the medium term. And we didn't specify the medium term. When I testified to the European Parliament, very often I was asked, what do you mean by medium term? And I said, I cannot specify that. And they said, but the Central Bank of New Zealand can do it. It's 1.5 years. Why can't you do it? Are you staff? Are you not able to do that? And my explanation was, for me, the medium term always starts with a new shock, with the measures you take until a new shock comes. So this is a moving time frame. To refer to this conference, Watchers Conference, the strategy was immediately criticized by the 4 Watchers group which existed at the time. The group, with a number of prominent academics, published a paper on the ECB strategy with the title, Unsafe at Any Speed. However, the introduction of the euro, the probably most significant event in the post-war history of the monetary and financial system, an historically unique regime shift, went seamless. It is hard to find any break in long-term interest rates, inflation expectations, or any other relevant monetary variables. This is clear evidence that the strategy and the pre-announcement have played a crucial role in this singular success. I cannot resist mentioning that, as evidenced, for example, by Olivier Blanchard's dinner speech on the 20 years history of the ECB in Sintra last year, as the whole Anglo-Saxon mainstream ignores or even denies the success of this strategy following the motto, that which must not, cannot be. The widespread criticism triggered the initiative to establish this Watchers Conference. The first meeting on 17th June 1999 provided an opportunity for me to explain and defend the new strategy. This confrontation, which over time became a stimulating exchange of views, was the center of the conferences which followed. I think it is worthwhile to mention that the ECB was the first, and as far as I see it, still is the only major central bank in the world that has established an open forum of this kind. The Watchers Conference has become a landmark in the communication with academics, financial economists, and journalists. I will now come to the new review. One might say that after 17 years, a thorough review of the monetary policy strategy of the ECB is overdue. What is the reason why it has taken so long to start this review? Is it because the strategy has worked well throughout this period in spite of fundamental shocks? Just to mention, as Governor Callow has just mentioned, the financial crisis of 2007-08 and the following Great Recession. Officially, the strategy of 1998, with the adoption of 2003, was never changed, but hasn't the ECB de facto not abandoned this strategy? The former Vice President Vito Constantio, when still in office, has explained in detail that the ECB has joined the camp of flexible inflation targeting and celebrated the modernization of the ECB's monetary policy. So I might ask, what exactly will be reviewed? The policy or the strategy or both? What is the connection? A few weeks ago, the Fed has published the result of its strategy review, which expectedly met worldwide attention. This is not the place for a detailed analysis, but one cannot avoid answering the question whether the Fed has set a benchmark for other central banks. Only two short observations why other central banks, and I think especially the ECB, should think more than twice before following the Fed. Analytically, it is hard to understand why average inflation targeting can better anchor inflation expectations around 2% when there is neither clarity on the past period on measuring the degree of undershooting, nor on the procedure for deciding on the length and distribution of higher inflation in the future. Further, the Fed notes that the maximum employment, its second mandate, cannot be directly measured and changes over time. As a consequence, no numerical objective will be set. However, the shortfall from this unmeasurable goal is a key factor for monetary policy decisions. In this context, the decline in the federal funds rate is related to the fall in the natural real interest rate, a rate which is not observable, and the empirical results are accompanied by high uncertainty. Volker Wieland has published on that very convincingly in my mind. On top of that, it is still debated if monetary policy has not contributed to its fall. Claudio Borri, for example, published on that. If this were the case, the argument for the reduction in the central bank rate would be circular. The Fed has now, on top, explicitly taken over responsibility for distribution. In his Jackson Hole speech, Powell highlighted that the long expansion, and I would add the expansionary monetary policy of the Fed, has continued. The gain, I quote, began to be shared more widely across society. The Black and Hispanic unemployment rates reached record lows, and the differentials between these rates and the white unemployment rate narrowed to their lowest level on record, end of quote. The claim for this remarkable success will backfire once the Fed will have to tighten its monetary policy. The political pressure not to hit the poorest member of society will be immense. It is obvious that as a consequence of the Fed's position, other central banks will be under strong political and moral pressure to concur with the leading central bank in the world that has taken over responsibility for a goal of such importance for society. Overburdening has already undermined the case for independence of central banks. Distributional politics, I think, must remain in the hand of governments and parliaments that are responsible to their voters. Central banks are not made independent to extend themselves, their mandate, which is given by the legislature. I would like to comment on all aspects of the ECB review. I have published a SAFE white paper encompassing monetary policy strategy review. Here, I will concentrate on the following. No model of inflation targeting exists so far which integrates the risks from the banking system and financial markets with all their dynamics, non-linearities, and overall complexity. Central banks should agree that the search for an optimal monetary policy regime has not come to an end, and inflation targeting might entail risks and shortcomings. Jordi Garley claimed that what is now included in the monetary policy pillar of the ECB could be part of the economic analysis. But I see no way how this could be integrated in an inflation forecast. I think no model of this kind exists. If you have it as a side field of considerations, then you have not a monetary pillar, but I don't know, a financial pillar, or however would you call it. From this perspective, one could argue that a situation in which major central banks follow the same strategy might also bring systemic risks, and that there are benefits to a more diversified and robust approach. Consequently, adopting a different strategy by the ECB needs convincing arguments. The simple question is therefore, has the two-pillar strategy failed, and should it be abandoned in favor of inflation targeting in the broadest sense? Is it not simply a matter of fact that the Governing Council has increasingly neglected monetary analysis when taking monetary policy decisions in recent years? Would this be evidence that the monetary pillar has failed? The relevant question is, would the ECB over roughly the last 10 years have conducted a different policy by applying the two-pillar approach that ends with a cross-checking of the information from economic and monetary analysis? The answer is straightforward, not really. Most of the time, the overall development of money and credit did not send signals for following a substantially different monetary policy. However, such observable equivalence by itself would not be an argument to abandon the monetary pillar, as there is no reason to believe that the observed coincidence of the information from both analyses will be permanent. If the future development of money and credit in a very, very broad sense did signal inflation risks going beyond the information from the economic analysis, and if this information were excluded in the inflation targeting approach, this might lead to a policy that endangers price stability in one or the other direction. With the present COVID-19 crisis prompting unprecedented expansion of central bank balance sheets in conjunction with large-scale fiscal accommodation, it might again become more important to pay close attention to monetary and financial variables. One reason for such a divergence could be the different time horizon of the economic and monetary analysis. The monetary analysis is designed to signal risks to price stability over the medium to long term. Research, in particular by the BIS, has identified lengths of financial cycles that go beyond the horizon usually covered by the monetary analysis of the ECB, included in the introductory statement of the President. Based on further research, extending the horizon of the monetary analysis might not only identify future risks to price stability, but also integrate aspects of financial stability into the framework of monetary policy. There exist convincing reasons for an in-depth review of the monetary policy strategy of the ECB. Confirming the de facto inflation targeting strategy via a simple formal adoption and putting the monetary pillar into the dustbin might turn out to be very risky for price and financial stability. Let me make clear, I'm not obsessed by the two-pillar strategy. In many discussions with my colleagues from other central banks, I listened to their critique and always said, if you present me a better approach, I will immediately adopt it. I never got an answer. But my conviction is, I asked them, how do you deal with that? And the answer was, no, we have not such a thing like a monetary analysis. I said, please explain me a better approach, but ignoring money and credit in a very broad sense, which was, for example, exemplified in the volume published by Lucas Papademos and Jürgen Stark in 2010, is showing a way how to extend monetary analysis. As an academic, I've written so many papers trying to respect roughly 200 years of monetary theory. When I became a central banker, I did not see any reason why I should neglect money and credit. So I think this is for me a challenge which has to be considered, to which the ECB needs an answer in its review, giving it up, explaining reasons, or modernizing it, extending it in a way which is a real challenge. To conclude, a review of the monetary policy strategy of the ECB is more than appropriate. At the same time, announcing a new review after so many years unavoidably raises high expectations. Analyzing the different aspects that will make up the review in detail might lead to a kind of soberness compared with these expectations. The monetary policy of the ECB and its communication have developed over the years under the challenges stemming from various severe shocks. Taking stock of the monetary policy conducted over the last 17 years could indicate that emerging problems and corresponding criticism were more directed to the performance within the strategy than deficiencies of the strategy itself. Overall, it would be risky to raise undue expectations of the strategy review, which will not turn out to be a panacea. Thank you for your attention.
Thank you very much, Otmar. Thank you for reminding us of the foundation of this ECB Watchers Conference, also from the debates within the Governing Council from day one, difficult and fruitful debates from day one. Thank you also for your remarks about the present strategic review on both sides of the Atlantic, including your remarks on the second pillar. I am sure they will open room for discussion, and I also alluded to the second pillar in my short introduction. I now turn to Petra Geraats from University of Cambridge. Can I only add, Petra, before giving you the floor, that your work focuses, among other, on central bank transparency and communication, a topic which has also been on the front stage this morning. So please, Petra.
Yeah, thanks very much. It's a great pleasure to have the opportunity to talk here about the ECB's monetary policy strategy, and in particular lessons from the financial crisis, the debt crisis, and the coronavirus crisis. I'll be covering each briefly in turn. First of all, lessons from the financial crisis. As already mentioned, the ECB took a very different strategy compared to other major central banks. It did not engage in quantitative easing through large-scale asset purchases. Instead, it decided to go and have different balance sheet policies by engaging in large-scale liquidity operations through the fixed-rate, full allotment, longer-term refinancing operations, the LTROs. These LTROs have the advantage that they allow the ECB to very quickly provide cheap and ample liquidity for the banking sector, and also great for temporary stimulus, temporary liquidity, because they have a fixed horizon. At the same time, they allow for very gradual and natural unwinding by having shorter-term rollovers or early repayments. However, there's a problem in providing so much liquidity. You don't know where it's going to end up. And the liquidity may not be passed on by banks into greater bank lending, and it may not benefit the real economy. In fact, the liquidity could end up increasing financial fragility, as we have unfortunately seen, with banks gobbling up the liquidity to go and buy higher yielding government bonds of the euro area periphery. So when those countries were hit by a sovereign debt crisis, it was no longer confined to these countries, but it had become a euro area-wide systemic problem, greatly complicated the response of the ECB. So this is an issue that needs to be dealt with, and one way in which the ECB has tried to do it is by introducing these targeted LTROs that are tied to the lending book, basically, and where banks receive more generous conditions if they increase lending. There's another problem with the large liquidity provided by the LTROs, and that is that they have pushed interbank rates close to the ECB deposit facility rate. As a result, the main refinancing rate is no longer a good indication of the ECB's monetary policy stance. And the ECB has effectively been engaging in monetary policy easing by stealth through lowering of the deposit rate. This is a problem from a transparency point of view. It is just not clear how we should read the ECB's monetary policy stance. It's no longer given by the main refinancing rate. Effectively, the ECB is operating a floor system with the interbank rate, overnight interbank rate, very close to the deposit rate. One way of solving this problem is by formally adopting it, a floor system, or at least to be transparent about which of the key rates that the ECB sets are really key and a key indication of the monetary policy stance. This monetary policy easing by stealth is illustrated in this graph of euro area money market. Before the financial crisis, the ECB main refinancing rate was clearly providing an indication of the monetary policy stance, and that's the thick black line. And Ionia, the euro area overnight rate, was fluctuating around it. Fluctuations became larger after the sovereign debt, the money market turmoil broke out on the 9th of August in 2007. But we saw a massive discrepancy arising after the collapse of Lehman Brothers. Since then, the overnight rate Ionia has been systematically below the main refinancing rate. When situation stabilized a bit when the ECB introduced the one-year LTROs in June 2009, then the main refinancing rate was at 1%. And the ECB was heavily criticized for not providing further easing. However, monetary conditions were a lot easier than that because the overnight rate was actually around 30 basis points, very close to the deposit rate of 25 basis points. So actually, the ECB provided more easing in that sense than the Bank of England, which had a bank rate and an overnight rate of 50 basis points. So the criticism that the ECB received was unfair, but it can be criticized for its lack of transparency. The introduction of 3-year LTROs further clarified, brought the interbank rate even further to the deposit rate. And it also showed that it's not the main refinancing rate that's determining the policy stance, because there were cuts in the main refinancing rate in 2013, yet they had no effect on the interbank rate. And also there was some convergence during 2014, when QE was introduced. Again, interbank rate was firmly pushed to the floor of the corridor and is now very closely following the deposit rate of the ECB. So since June 2014, the ECB has had a negative deposit rate. The Eurozone has had negative interbank rates, overnight interbank rates. And not just those rates, also there have been negative yields in the euro area on sovereign debts since 2015. Initially, it was confined to short-term yields, but now it has greatly extended. For instance, right now, the yield on 5-year German government bonds are minus 70 basis points. The yield on 10-year German government debt is minus 50 basis points, the same level as the ECB deposit facility rate, suggesting that if you use the term structure of interest rates, that markets are expecting that that level is going to prevail for the next 10 years, which is quite remarkable. But those negative yields have also been driven by the ECB's asset purchase program, which was announced in January 2015. Now, a good thing about negative deposit rates and negative yields are that they reduce appreciation pressure on the currency. That can be incredibly useful for small open economies. At the same time, they provide direct relief for governments because they reduce the burden of sovereign debt. However, that could also lead to moral hazard and reduce pressure on the governments to maintain fiscal discipline. But for short-term alleviation and making sovereign debt more sustainable, it's definitely helpful. Another problem with negative rates is that they are effectively a tax on the banking system. banks have to hold reserves at the central bank to do their business. And now, with a negative deposit rate, they are effectively taxed based on it. One way of solving this issue is by having tiered rates, as the ECB announced in September last year. Another problem is that negative rates may actually not stimulate bank lending and stimulate the economy because of a reversal rate when the loan interest margins are compressed for banks, and as a result, they may not wish to go and increase bank lending and pass on the benefits to the real economy when rates are reduced further. And the existence of such a positive reversal rate is a great complication. Also, there's a lot of uncertainty about what the level is. There's definitely something like that operating as a potential drawback. Another problem is that negative yields can endanger financial stability. They are likely to induce a search for yield where investors are going and buying assets that are riskier. In addition, just the whole phenomenon of negative bond yields is truly remarkable. So basically, textbooks have been written that nominal interest rates cannot be negative. And clearly, that has been thoroughly refuted by the facts. And what we see is that investors are buying bonds at such a high price that if they hold the bond to maturity, they are sure to make a loss. So why are they buying the bonds? Well, either because they have to, banks have to satisfy regulatory requirements, although the negative rates basically impose a tax on them as a result. But another reason for buying the bonds at a negative yield is because you expect that the price will increase even further, that you will be able to sell the bond at a positive return at an even greater fool who will pay an even higher price. Now, on the usual conditions, that would be extraordinary to assume, and it's by definition, you're in the situation of a bubble. But here we have a very large-scale buyer in the form of a central bank engaging in these large-scale asset purchases. And that is basically what is perpetuating what, by all normal standards should be interpreted as a bond market bubble. The problem with bubbles is that they tend to collapse suddenly. So they don't usually gradually unwind, but they burst with a bang. So the whole process of unwinding negative rates and asset purchases, and including the latest version of that, the Pandemic Emergency Purchase Program, needs to be done extremely carefully. Because there is a serious risk that suddenly, it will all unwind and bond yields will go up very quickly. And that would, of course, could kill an incipient recovery. But even now, there's no thought about unwinding for the foreseeable future. Effective macroprudential policy is definitely needed to mitigate the risks that are present because of negative rates and yields. Next, I'd like to move on to ECB monetary policy transparency. ECB has significantly improved its transparency during the last 2 decades, including the publication of staff macroeconomic projections in 2000, and it became quarterly in 2004, the publication of the ECB's euro area-wide macroeconomic model in 2001, publication of the minutes, or the account as the ECB calls it, of the monetary policy meeting, more recently in 2015, and introduction of explicit forward policy guidance in 2013, which was made quantitative in 2016. Now, these improvements can be illustrated using an index that's put together with Nurgit Dinter and Barry Eichengreen. This is the latest version of it, updated to 2019. So the index basically measures whether central banks engage in information disclosure with respect to several aspects of the policymaking decision process. And what we see here is that in the early years, the increase in transparency was primarily driven by an increase in the economic aspects of it. So the publication of ECB staff projections, the model. And the more recent increase in transparency was driven by greater policy transparency, in particular the use of forward guidance. But as we see, there's still quite some room for improvement, and the maximum score is 15. So what could the ECB do to improve its transparency further? As a few people have already commented on, it would be very useful to have greater clarity about the ECB's inflation goal, because stating below but close to 2% is really very fuzzy, because it doesn't clarify how close to 2%. Is it 1.5% in line with the monetary reference value that the ECB published in its early years? Or is it like 1.7, 1.9? We don't know. It is definitely very opaque. Another way in which the ECB could improve its transparency is by releasing its account of monetary policy meetings more promptly. Currently, they are released with a delay of 3 to 5 weeks. And with a bit of effort, especially now everyone is used to teleconferencing, I'm sure that the ECB can reach agreed minutes with a delay of less than 2 weeks. That should be feasible. Other central banks do the same. That would be very helpful, because information becomes stale, especially when we are in periods of lots of volatility and uncertainty, and releasing the minutes more quickly would be a very good idea. However, I do not recommend to release the minutes instantaneously, as some central banks, particularly the Bank of England, has started doing. The problem is that approved minutes cannot be produced overnight. So if you release the minutes at the same time as the monetary policy announcement, then that means that the actual decision, the genuine deliberation, will have to take place a lot earlier. In the case of the Bank of England, a full week before the actual announcement. And a lot can happen in a week, as we know, as we have observed, especially when we are in a pandemic. So then either the central bank has to go and redeliberate, and still faces the problem of producing minutes, agreed minutes, or the central bank has to decide to just disregard the latest developments, and its monetary policy is stale by the time it is announced. So please do not follow the example of the Bank of England in that respect. Do not attempt to distort your policy-making process by releasing the minutes at the same time as the meeting. It's not a good idea. Transparency should increase the effectiveness of monetary policy. It should not distort decision-making. Another way of improving transparency is to disclose the voting balance for monetary policy decisions. There may be still some discomfort releasing the individual voting record, but the voting balance would already be very informative. Another way to provide greater transparency is to provide more comprehensive time-dependent forward guidance through the publication of a projected policy path, supplemented by state contingent guidance through scenario analysis. And especially when we are in the middle of a pandemic, I think that central bankers can learn from the use of scenarios and planning, and scenario analysis can be really very useful in the communication of potential monetary policy reactions. So I very much hope that the ECB will do much more on that. And finally, ECB could improve its transparency by having an annual evaluation of its staff projections, and indeed an annual evaluation of ECB monetary policy. That's particularly important when the inflation goal of below but close to 2% has been so persistently missed. It is important for the credibility of the ECB's monetary policy, it's important for its transparency, but also for its accountability, which is vital to maintain the legitimacy of the ECB as an independent central bank. Now, lessons from the debt crisis. Here, the ECB learned the power of central bank communications. Mario Draghi's dramatic statement that the ECB will do whatever it takes within its mandate to preserve the euro area as a single currency was incredible. And the announcement that followed of the outright monetary transactions program in September 2012 of potentially unlimited sterilitzed debt purchases subject to conditionality and only for shorter term bonds. These communications were so effective that periphery bond yields declined, while the OMT program is still unused. So this really shows the power of central bank communications. However, the debt crisis also brought home the lesson that the euro area is definitely not an optimum currency area. Instead, the euro...
Can I suggest, Petra, sorry, that you try to conclude in 2 or 3 minutes?
Okay. So you're cutting me off much earlier than Otmar, just for the record.
No. I promise to you.
Now, the euro...
No, we are a bit more than 15.
And just when I get to the more delicate issue, then of course I'm interrupted by the governor.
Please, please.
So the euro area is a multi-country monetary union that faces fragmentation risk due to differences in spreads that are potentially self-fulfilling. So it is vital to have a credible backstop and regular reassurance. And that's also makes it so problematic when President Lagarde made this comment about we're not here to close spreads. That's very problematic, given the fragile situation that the euro area finds itself in as a multi-country monetary union without a fiscal union. Next, the ECB Forward Guidance. So the ECB has used forward guidance for liquidity measures, but was slow to use it explicitly for monetary policy. They did it implicitly through the use of strong vigilance, signaling a tightening, but they only started using explicit forward policy guidance in 2013, when they used the extended period phrasing to indicate that rates are likely to remain at present or lower levels. Then they moved to calendar-based guidance, in first instance just for the monthly asset purchases in 2015. And then the low rates, prospect for low rates was tied to net asset purchases. So that essentially also became calendar-based. But right now, the ECB has threshold guidance. Unlike the Fed, the threshold guidance is not based on inflation, which is easily observable, but on the inflation outlook, robustly converging sufficiently close to but below 2% within its projection horizon. And this convergence should be consistently reflected in the underlying inflation dynamics. This is a very fuzzy formulation, and it's not clear how to interpret these things robustly, sufficiently, so it's hard to figure out when the ECB is likely to go and increase rates. However, the principle of state contingent guidance is a very useful one because it provides much greater flexibility. As the economic outlook deteriorates, people know that the threshold is less likely to be reached, so they reduce their expectations for future policy rates, providing further stimulus to the economy. So it acts like an automatic stabilizer. The way the ECB currently implements it is rather fuzzy and could use a lot of improvement. Next, the lessons from the coronavirus crisis. The ECB responded in a big way through the pandemic emergency purchase program. More than $1 trillion could be provided this way. Also through pandemic emergency longer-term refinancing operations, more generous conditions on TLTROs with rates of -0.5% to up to -1%. However, unfortunately, monetary policy is poorly equipped to address the coronavirus crisis. It's a shock to real demand, and effective fiscal policy response is vital. In addition, so we know that a lot of investors institutions are already highly indebted. That will now increase even further, same for governments. And banks are being stimulated to provide loans by the ECB, but we know that loan losses are going to be inevitable. So the macroprudential policy framework is going to be seriously tested by this crisis. Now, finally, to conclude, what about the ECB's monetary policy strategy? It started off with a two-pillar strategy, as Otmar mentioned. Unfortunately, the initial version of it was rather opaque and confusing because it was not clear which pillar the ECB was using when. But this was fortunately clarified after the 2003 revision, where the economic pillar is basically the main pillar and the monetary analysis pillar is for the longer run and cross-checking. Following the financial crisis, the euro area inflation average dropped from 2.2% before the crisis to 1.2% after the crisis. Was that due to a failing monetary policy strategy or due to structural forces affecting not just the euro area, but also other economies? So should the ECB go and follow the US and adopt average inflation targeting? Well, average inflation targeting sounds very attractive in theory, especially in New Keynesian forward-looking models. However, aiming for higher inflation may be hard to achieve. Just look at the Bank of Japan. They really tried pretty much everything. They managed to get rid of deflation, but despite aiming for 2% inflation, they're not really getting there, even after several years. Other problem with average inflation targeting is that it creates uncertainty about the size and the duration of an inflation overshoot. And this uncertainty risks unanchoring inflation expectations, which then further increase volatility, which is encouraged by allowing overshooting of the inflation target by the central bank. And finally, if you have a symmetric average inflation target, then the problem is that inflationary supply shocks would require more painful tightening. Just imagine a shock like the oil price shock of the 1970s, with inflation reaching double digits. They would require inflation well below the target and tremendous tightening by the central bank to reach the average inflation target. So I do not think this is a good idea. What should the ECB then focus on? Well, I think that the ECB should first focus on improving the fundamentals underlying the economic and monetary union, including making sure that there's a proper banking union with effective supervision and resolutions, that we don't end up with a similar situation as the debt crisis. To have macroprudential policy that is effective in managing risks associated with loose monetary policy. But last but not least, also to make sure that there is a fiscal policy framework that provides greater flexibility to provide stimulus to the economy when it is needed, and that provides sufficient room for public investment. The ECB has been very unusual among central banks in routinely commenting on fiscal policy and the need for structural reforms. It has been so effective in this that when the need for expansionary fiscal policy was there, that countries felt too afraid to actually do it. And the framework that we currently have in the form of the Fiscal Compact, although it has improved compared to the Stability and Growth Pact, it still does not provide room for public investment, thereby hampering efforts of countries to engage in structural reforms. That really needs changing, that needs fixing. When it comes to macroeconomic policy, it takes two to tango. So I very much hope that the current president of the ECB will be able to persuade governments of this, that fiscal policy will have to play its part in this process. And that's going to be vital for the ECB to continue to thrive in implementing monetary policy. It should not be the ECB itself that does the heavy lifting. It has to be in complement together with bank supervision, regulation, macroprudential policy, and effective fiscal policy. Thanks very much.
Thank you, Petra. And I can reassure you, you had more time than other speakers to communicate. Then we will go to John Teller. I don't need to introduce John, only to thank you, John, because as you are in California, as I understand, it's 6 in the morning, so we do still more appreciate your participation. Please, the floor is yours.
Thank you very much, Francois. It's sorry the lighting is not as good as you like. I'm not sure what the problem is here, but I'll have some slides. First, let me say it's good to be back at ECB and its watchers. I was at the very first meeting that Otmar referred to in 1999, and it's continued to have a very constructive influence since then. I want to say that there's the focus here is on strategy. I think that's a good idea. The word strategy itself has some benefits. To me, it conveys a rule more than just arbitrary discretion. And the idea of focusing on the financial crisis and including what's happening recently seems fine. On the first slide, which we can go to, I'd like to emphasize some positive aspects of the ECB policy strategy as it exists. And of course, there can be improvements, but these are things that I think have been mentioned by Petra and by Otmar. This emphasis on transparency and clear communications has always been important. Of course, the goal of price stability, that just barely 2% was there from the start. I think the endorsement of other kinds of policies, structural policies, has been an important part of the message. I think, and Petra just mentioned this, the emphasis on the automatic fiscal stabilizer, sound budget, which are part of macro, it's important to mention. And I think there's been this encouragement of opening capital markets. And finally, just mentioned Mario Draghi back in 2016 emphasized that we will all clearly benefit from improving communications over our reaction function. So these are positives. And go to the next slide. I think some things that maybe, at least from my perspective, are not so positive, going back into the history as was suggested. So if you look at particular episodes, I'll look at 2003, 2006, and then a more recent one. I think there's evidence that there were deviations from the strategy. Not sure where they all came from. Part of it is international. I want to stress that. And I don't mean things like whatever it takes. That's a different issue, which is a matter of communication. But I want to have a few charts. Just they're busy, but let's go to the first one coming up. It's a chart which shows you the estimates of the deviations. This is a chart. The next, if you could show the next chart. Yeah, this is basically deviations of policy from a rule. And you can see during this period, this is the earlier period, this is before 2000, before the crisis leading up to the financial crisis, there were quite a few deviations in Ireland and Greece and Spain where the rate was really too low. And it's a problem that exists whenever you have different circumstances. The solution, of course, is to have more of a rate which is averaging correctly. So this is not the only study. The next one is another study which illustrates the same thing. So if you go, yeah, this is again another busy slide, but here the focus is just on Germany and other countries in the European zone, Eurozone. And you can see that the rate really was, by this measure, too low in countries, not Germany in this case. And that shows the top, and the bottom shows that this led to excesses in housing prices, excesses in mortgage lending in the countries where the rate was too low. So that's another example where maybe the strategy, which was strategic, I think that's important, but was not as good as it could be. And then finally, there's the next chart. Again, these are busy, you can look at them later. The next chart comes from the German Council of Economic Advisors, and I thank Volker for his work on that. And it basically says the same story. This is basically looking at France and Italy compared to Germany. And you can see the rate was too low in some of the countries, France, Italy, and Spain, leading up to the crisis. And I think that we can't discount that as one of the issues that were faced. And so these are ways, if you like, to think about the previous crisis. Now, why did this happen? Well, there's debate about that, of course, but the next slide kind of illustrates why I think it happened. I think to some extent, central banks look at each other. The exchange rate is a big reason for that. And this just shows you in the period before leading up to the global financial crisis, there was this relationship between what the Fed was doing, is illustrated by one of these lines, by the red line, and what the ECB was doing. So rates were a little lower on average than they might have been in Europe because rates were a little lower on average than they were in the US. And that was exchange rate, I believe, had an impact on that. So there's a connection, and that's one of the reasons we need to worry about this going forward. If you look at the next slide, I think it illustrates more recently, the connection between the exchange rate and the policy. So in this case, the red line is the reserve balances at the ECB, and the blue line is the dollar euro exchange rate. And they're quite related. The most important one is the period where there's a depreciation of the euro, and it associated with this big increase in the reserve balances. And I think that's to some extent, that was the period where Mario Draghi mentioned the concern about the value of the euro, and that brought it into play. So one of the reasons that the policy may be deviating from the strategy, a rule which is best for the country, are these international considerations. So that's really the things that I mentioned leading up to the global financial crisis. Now, what is interesting to me as an observer, going back quite a few years, is how things began to change recently. And I want to give an example of that from the Fed. So if you could go to the next slide, and these are a summary of papers written very recently. Bernanke, Keeley, and Robert, it's just last year. And they looked at different strategies, policy rules using the Furbis model. Mertens and Williams, John is now at the New York Fed. They looked at different rules with a new Keynesian model. This is just last year. And Sims and Wu, a similar thing. So these are just examples. And I think things were moving in this direction, which was quite positive. The last point is in the Fed's reports, there was a whole new section on monetary policy rules, strategies, the same thing to me. And there were quite a few. And if you go to the next slide, I'll just show you a quick review of what this is. So these are the monetary policy reports that the Fed had been issuing. And you can see there's different policy rules listed at the bottom. So the effort here was to compare the strategy with specific things that have been mentioned. Of course, things like the Taylor rule, the balanced growth rule, price level rule, they're there. And the computation of how the actual strategy at the Fed was comparing with this was important. And of course, Janet Yellen began to refer to this, Jay Powell began to refer to this. And I think it was a very constructive development. Now I say was because the most recent monetary policy report of the Fed doesn't have these sections. It's gone. And I think that reflects the big changes that are so important and why it's important to have this kind of review that the ECB is going through. And I enjoyed very much the speech by Christine Lagarde. It was 1:30 in the morning out here, but it was important to watch. So if you could just go to the next slide, and I'll show you how things have changed. Everyone knows this, but this is a reminder. This is a map of the world in terms of growth rates back in just last year. And it basically shows positive growth all over the place. But we have just been hit by this enormous COVID-19 coronavirus event. And so you can quickly see if you flip to the next slide, how it's changed. These are all the negative growth rates all over the place. And of course, the US and Europe, the year's not over, maybe not be quite this bad, but it looks very bad. This is a forecast, these are all IMF forecasts. And it's good that certain countries are not going, but the world outlook has changed completely. And that's really why it's important to have this review and why I started by saying there's some good things about the policy that we can start with, not give up, including the transparency and communications, which are emphasized. Now, I'd like to, as given this situation, it's in this picture, it's amazing, just quickly go to what the Fed has done, because they have really completed their review. And I'm also have views that are sympathetic with what Otmar and Petra mentioned about the impact of this on the ECB. So let's quickly go to the next slide, and you can see this is the federal funds rate. It had been normalizing towards the end of last year. It was increasing both the upper and lower levels. And then, of course, it plummeted when the crisis began. Then the next slide shows you this is not just a one-off event. These are the famous dots that the FOMC has put out. And you can see they have near zero, between 25 basis points and zero, out several years. And even when they're back to normal, that's the oval that's circulated, it's quite low compared to the 4% where it was beforehand. And that lower number, I think, reflects the reduction in the so-called R star, the equilibrium real interest rate, which we have been discussing and I worked on with Volcker as well as Otmar mentioned. So this is a big issue, but it's not an issue right now because they're well below this number. And of course, the ECB is negative. Now, if you quickly go through the other parts of policy, which are very important now, the first one, just the next chart, which you flip to, is the balance sheet, the Fed. This is the Fed. And you can see the balance sheet, this is, as mentioned by the asset side, it increased dramatically, the great financial crisis. And then it had started to come down last year, the year before, in this normalization process. And then, of course, it reversed during the crisis. Now, there are many good things to say about that reversal. There was a sense of markets stayed open, and I think central banks need to pay attention to that particular episode in March and April of this year. But it's still going, it's still moving. And the question is how long that should continue. Is there a time to adjust to come back to some kind of strategy? I think there is. So if you quickly go to the next two charts, these show you money growth. And I know the ECB has always emphasized this aspect of policy, money and credit. This is quite an amazing picture because there's been a huge increase in money growth this time, which didn't occur with the quantitative easing, with the asset purchases last time. So this is a phenomenon that needs to be examined. It has to do with the banking system and the different policy of the Fed. This is so-called M1. If you look at the next chart, you'll see M2 is the same story. And it's this incredible burst. You didn't see that in the global financial crisis. So it's something that is a different kind of policy. And I think we need to be concerned about that going forward, how that's going to be reversed, if it's going to be reversed, to what extent this is part of the stabilization that we've had. So those are the changes that are happening as we speak. I want to now go to what Otmar referred to and Petra as well, and that is the Fed's review. So if you could go to the next slide, I've got a summary of that. Of course, in the Jackson Hole conference just a month or so ago, Jay Powell gave a speech and he coined this term, flexible average inflation targeting. And it's had a huge amount of attention in the press and academic circles. In his speech, Jay referred to some of the work done at the Fed. I'd recommend the ECB staff look at that if they haven't already. But of course, the conclusion was that, this is quotes, following periods when inflation has been running below 2%, appropriate monetary policy will likely aim to achieve inflation moderately above 2% for some time. And so the some time is vague. I mean, in some sense, there's always been an averaging. No one would look at the monthly inflation rate as a measure of performance. There's always been an average, and we're not quite clear how long this average will be. I think more clarity about that would be good. The other thing which I'll quote from the speech, which I think are important, one is in seeking to achieve inflation that averages 2% over time, we're not tying ourselves to a particular mathematical formula that defines the average. So there's a vagueness about this. It doesn't have to be precise mathematics, but I think it would be preferable in thinking about this average inflation notion if there was some precision about that. And then finally, this is something that, quite frankly, I think we need to pay attention to. Our decisions about appropriate monetary policy will continue to reflect a broad array of considerations and will not be dictated by any formula. So if you don't like formulas, this is fine. But I think to some extent, you could see this both in Petra's talk and in Otmar's talk, as well as Christine Lagarde's talk earlier this morning. There is an emphasis on formula, on techniques. That's how the various policies have been evaluated. And I don't think we should be forgetting that going forward. And the ECB needs to think about the vagueness of this, needs to make their decision themselves. Obviously they will, but also note that in this story, the international effects have not been insignificant. I just finished a book on that, which shows internationally there's quite a bit of connection between central bank decisions and it's related to the exchange rate. So let me conclude with the last slide, which is partly a reminder that so many other things are going on in this economy. And I think my conclusion is, as the economy recovers, we need to think about this strategy again and to return to a monetary policy strategy that works. It looks like the recovery is V-shaped. And I just list a bunch of things here that are true generally, but maybe they pertain more to the United States, where I am. So non-store retail sales, internet has been increasing very rapidly. Telemedicine is exploding. Video conferencing, the kind of thing we're doing right now, is going. The Zoom video communications has just been an incredible expansion of profits from the founders, as well as a benefit for us. I am now this term at Stanford giving a course completely online, 350 students who are Stanford students all over the world, in India, in China, in Europe. And it's a phenomenal thing that's happening. I don't think we're going to abandon that completely. There's going to be remnants of that even when we get back to normal. Of course, Facebook's make a lot of publicity about this. So there are forces at work which I hope will continue to bring us back to a better situation that look V-shaped. We don't know what it'll be like in the future. But I think what I see from what has worked and what hasn't worked, the strategy has worked. The deviations from strategies have not worked. There's many, many examples of this. It seems to me that the emphasis here, as much as possible, should be a more rules-based policy. And there have been big elements of that in the Fed, as I mentioned, and the ECB and other countries. But this recent event has taken us away from that. There's very little discussion about how and when there'll be a return to normal. And then finally, it seems to me, when you look around the world, you look, say, just the Fed and the ECB, there is a connection which is frequently forgotten. And that is this connection internationally. And a lot of it has to do with exchange rates. It may be inadvertent. I gave examples of Mario Draghi referring to it. It happens all the time. And to some extent, that can be driving policy. It may drive a connection between these reforms. So the Fed's reform, the ECB's reform, may be a connection for those. So I would just be particularly wary about that when you're considering the new review, this new, I like the idea of strategy review that is being undertaken. So let me leave it at that. These are observations based on way back to the global financial crisis and what I think led to it, as well as the reactions that we've had so far in this current coronavirus COVID-19 crisis. There are lessons all over the place. And I think part of the lessons is to stick with what works. Don't throw out things that are working as you modify to get a better system. So I'll leave it at that. Thank you very much.
Thank you very much, John. You have been eloquent in pleading a return to rules-based policy, and we were not surprised coming from yourself. But I liked also your hope of a V-shaped recovery. I liked it. I don't know if I completely share it, but it was music to all our ears. And also what you said about the role of international monetary transmission in the past deviations. Volker, I am now in your hands. Do I pass the baton back to you for the questions, or do we give the floor directly to Dirk Schumacher, who is registered as the first lead questioner?
Yes, exactly. I think we have Dirk here, and so he's going to be...
Perhaps, Volker, we could take the three lead questions in a first group and then give the floor to our speakers.
Absolutely. I mean, we might also be able to take actually 2 rounds. But let's take the 3 questions. So Dirk is starting, and the other 2 questions are in writing. So if it's okay with you, I'll just read them.
Okay, okay. Dirk, please.
Yep, thank you. My question concerns the rising debt, corporate debt, but also sovereign debt, and what it may imply for central banks going forward. I mean, whether the recovery is going to be fully V-shaped or not, we shall see. But the one thing that's sure is that debt levels will be a lot higher. Probably in the euro area, something like 20% debt to GDP increase is what we're going to see, and in some countries even more. And to what extent will this, or should this be actually a binding constraint for central banks going forward once they want to normalize at some point? Should they incorporate that? Does it make it necessary to spell out more clearly the interplay between fiscal and monetary policy? We heard a lot this morning that this was needed, that monetary policy itself is not enough. We need fiscal policy, and one consequence of it is a rising debt level. Much of that will end up at central bank's balance sheet. So how do we spell this out more clearly, what that implies? And finally, doesn't that all that mean that the monetary transmission mechanism will change in a meaningful way? In an economy which is more leveraged, interest rate changes should matter more than in one where there's less leverage, all else equals. Thank you.
And Volker, I understand you will read the 2 next questions.
Yes. From Julian Callow, what does the panel think that the ECB's strategy should address, which has not yet figured so large in discussion, including those today? So are there other things? From Sylvain Broyer, a world of perpetual QE is likely to become the new normal. I wonder what the combination of the zero lower bound and perpetual quantitative easing means in terms of forward guidance. Should central banks communicate on the shadow rate, the policy rate adjusted downward by the amount of QE, rather than on the policy rate? So that's the third.
Thank you very much. Can I suggest that we take this first round of questions, and each of our panelists takes the question he wants. He can also answer to the others briefly, starting with Otmar Issing, if you agree, Otmar.
Thank you, François. I would like just to take up very shortly 2 points by Petra and by John. Petra, you have a sympathy for shortening the time of the publication of minutes or whatever you would call it, closer to the decision day. There's a trade-off, of course, between accuracy of presentation, etc. Remember when the Fed decided to reduce the time lag between the publication of its minutes from 6 weeks to 3 weeks. Federal Reserve governors have complained that they have not enough time to make revisions of the text to improve the text. So I think the ECB was very modern in this respect. It published the considerations in a very short form, introductory statement, on real time. On real time. Of course, then you cannot have an extended presentation of views, but it was on real time. And I think this was a landmark. We made a big mistake. We should have called it minutes and not introductory statement. Introductory statement has no sex appeal. And when you see minutes, you have a feeling as if you had attended. But the difference is not such, because they are all well-drafted documents. So there's a trade-off. I'm not sure what the optimal time lag is. And to John, having read your last book and having listened to you, implicitly, explicitly, you are concerned about the consequences on the exchange rate, and implicitly the exchange rate development in open economies plays a major role. If you take also China on board, then everything, not everything, but a lot depends what is decided, for example, by the Fed, what are the potential consequences of the exchange rate. So as monetary policy measures cannot be coordinated, and I think should not be coordinated in time, The coordination is that I understand your proposal is coordination on having the same rules, the same concept. Now with the review of the Fed, the undergoing review of the ECB, is there a threat that, so to say, concepts, strategies, if you wish, rules diverge, and the consequences will be much more volatility or misalignment even in exchange rates?
So next, first to comment, to react on Otmar's comments. Yes, there's a trade-off when it comes to the delay with which the minutes are being produced. That's why I also say definitely don't do it at the same time as the announcement, as the Bank of England does. That's just the wrong way around. It's distorting the monetary policy process. However, I think that it can easily be done in 2 weeks. Other central banks have done it. And it may take like some rescheduling in some ways. When I look at the Central Bank of Chile, where I was involved in a major evaluation of the whole monetary policy framework, as well as financial stability, they publish minutes with a delay of a week. So it can be done. It's just a matter of like how you go and set it up and organize it. But I think that 2 weeks would be, a reasonable amount of time. And that's especially important when you are in an uncertain and volatile world, as we currently are, because news becomes stale very quickly. And one of the things that's important about minutes is that it gives you an insight into the thinking of the monetary policymaker so that you can better understand the monetary policy reaction. Then, with respect to Otmar's comments on that, they really should have called the minutes, the introductory statement minutes, that were tongue-in-cheek sometimes referred to as Duisenberg minutes. Well, the introductory statement is very different from minutes, in my view, because they didn't really tell much about the discussion that was going on. They were just presenting some arguments, and you didn't get any flavor of the discussion and any idea about what the balance of thinking was. So I strongly disagree, I'm afraid, that I do not think that the introductory statement is a good replacement of minutes. With respect to John's concern, the Fed's average inflation targeting framework, I fully agree with his concerns about the vagueness in some of the terms. It's far from transparent. I also agree for his promotion of systematic monetary policy, although I would not call it rules-based monetary policy, for the reason that, in my view, monetary policy is too complicated to formulate in a simple rule. It's like trying to write down a complete contract. It cannot be done. There's so many potential contingencies. But I think it is very important that monetary policy is systematic, so that it is predictable and understandable, because that will make monetary policy more effective. With respect to the questions from that were coming from the floor, so first of all, Dirk's question, the rise in debt is indeed a major complication. It does change the monetary policy transmission, for sure. It leads to greater vulnerabilities. Is this something that central banks should be concerned about? In an ideal world, macroprudential policy takes care of that. But unfortunately, we don't have a test and tried framework for macroprudential policy yet. So yes, under the current circumstances, central banks should take that into account, and especially when they're thinking about tightening policy, that they're not in the same world they were in previously before the pandemic. With respect to the question on perpetual QE and forward guidance, should there be forward guidance on a shadow rate? So in my view, there should be forward guidance with respect to any main policy instrument that the central bank uses that improves its effectiveness. So forward guidance about policy rates so that interest rate expectations can adjust accordingly and reduce longer-term interest rates and provide further stimulus. but also with respect to large-scale asset purchases. And it's actually very interesting because many central banks, when they announced large-scale asset purchases, they didn't do it month by month, but they actually made an announcement about a large purchase that was going to take place over several months. When the ECB introduced the asset purchase program, when they announced it in January 2015, at the same time they indicated the intended horizon for the monthly asset purchases. That effectively is a form of forward guidance. And the reason why central banks do it is because they know by announcing it in advance, you benefit from these anticipation effects and you have a bigger impact before the policy has even been introduced. So in my view, it should not be forward guidance with respect to some kind of hypothetical construct like a shadow rate. No, it should pertain directly to the policy instruments that the central bank has, whether it's interest rates or whether it's the balance sheet.
Thank you. John, if you are kind enough not only to answer to our speakers, but also this question from the audience about issues which should be, according to you, in the strategic review, but which have not yet been addressed since this morning, please.
Well, I have to say, one of the things I would stress is this systematic, predictable, strategic aspects. Those are words that are important. They don't come out quite enough. You know, how will policy be operating going forward? So the more of that, and it's missing so far. I think the second thing is the QE. I would like to see, if QE is going to continue, I'd like to see that also made more predictable, more systematic, rather than just whatever is appropriate at the minute. So those are my answers to that. I think just to briefly say, Otmar is correct to think about the exchange rate, and policies can be different in different countries. I think the problem is paying too much attention to the exchange rate rather than to what's happening in the countries. But that remains, that is more research that is necessary. I do not think that has to be the same. The Fed could follow its flexible average inflation targeting. We'll see how different that really is. And the ECB might try something else. I think finally, I say that Petra's comment about rules and other terms, I completely agree. The word rule has a connotation which is more formulatic, more model-based than systematic or predictable or strategy. I've tended to focus more on the latter three terms occasionally, but the models, the things that economists work on at central banks and elsewhere, they do have these formulas. They do have these, so more of a connection between that and what's actually said would be very useful. And you don't have to have one model. Volcker has a terrific model database, Volcker Wieland, with 150 models. And so you can try out different things. But I think separating too much from the analytical work is a mistake. I'd like to find ways to connect those more closely.
François, may I make a short answer to Dirk Schumacher's question?
Please.
Very short. I think this is a big concern. And the notion that you can accumulate debt without limit is based on the assumption that long-term interest rates will remain flat, will remain zero. For future monetary policy, this will imply a tremendous challenge because any increase in central bank interest rates will bring big problems for countries, especially high indebted ones, and also for bondholders and banks. So the longer this goes on, the more problematic the exit will be.
So thank you very much to the three of you. It has been a very lively discussion. Volker, I don't know if we have some time for a second round of questions from the floor.
I think we have.
Or not.
I think we should, because
okay,
we haven't done it in the previous.
You should organize it, probably.
Yeah, let's look if we can allow some questions which came in via Slido and which have been voted up. Can we take a look at what's been voted up online in terms of questions, if there is one? Okay. In a world of so low interest rates and in the light of the pandemic emergency program, isn't the case that some highly indebted countries like Greece take advantage of the program and follow an aggressive policy of purchase of their own debt? Evangelos Stravelas. Okay, that's one question. Maybe let's take one more. Is there another one also? By David Marsh. Hey, David, good to see that you're listening. Professor Issing, limits of European primary law effect of constitutional court. Expanding ECB remit towards monetary financing would require a treaty change. Berlin governments haven't wished this. Is it becoming inevitable? Would that require a referendum in Germany? If so, what would be the result? Maybe let's take a third one, then we can go back to the panelists. So is there a third one? No? Okay, so let's go with those two, unless there's a question from the floor. Yeah, so there are two questions actually. So I think there's a mic here. You want to? So let's take these two questions here from the floor and then close.
Thank you. So this is a question from Krishna Guha and Evercore Partners, particularly for Mr. Issing. So you referenced the Fed review and the possibility that this could push the ECB towards more of an inflation targeting approach. I don't think that's what the Fed's actually doing. I think in many ways the Fed is looking for a model that lies beyond traditional inflation targeting. What I think the Fed is saying is that in an era that's dominated by the proximity of the lower bound, if you only ever shoot for whatever your inflation goal is in periods when you're not constrained by the lower bound, and then you have weak inflation performance in periods where you are, on average, you can't achieve your inflation goal. And on average, you won't be able, therefore, to sustain inflation expectations at target. So is there anything about the ECB's framework that, in your mind, would prevent the ECB itself from taking the approach that in order to stabilize inflation at target over the medium term, in order to stabilize expectations at levels consistent with that, it ought to aim for a number a little higher than the medium-term goal in periods when you're not CLB constrained? Thank you.
Okay, one more.
Investment. I would have two questions, if I may. The first one is, do you see a danger that in the discussion on the strategy review that we had today, we're sort of fighting the last war or the last battle? In the sense that I found today there was a somewhat excessive discussion on the past undershooting of inflation relative to central bank targets and a desire to move those targets higher in order to get a little bit of inflation at a point in time where, you know, as Christine Lagarde said today in her speech, there may be actually an inflation revival in the system building up. Christine Lagarde, in one of the footnotes to her speech this morning, made reference to the latest book by Charles Goodhart, which explains why, through demographic changes and also, you know, the costs of the pandemic, there may actually be we just at a point in time when there may be a little bit of inflation creeping back into the system, and just at that point in time, central banks are about to change their inflation targets and are about to tolerate or even call for temporary overshoot of inflation. And the second question, just briefly, with respect to the strategy review, I think what was missing today was the entire discussion about climate change, frankly. When I have to explain to my daughter what we've been discussing here today, she really wouldn't understand. And I think you can call it mission creep, yeah? You may not like it, but there will be there's a social demand on central banks to find answers to, you know, these questions and to the challenge that we're all facing, which is a total change in our business model that we have in the European economies. So I think the ECB cannot be silent on that. Thank you.
Thank you very much. As these are 5 excellent questions, can I ask each of our panelists to be as short as possible and perhaps to focus on two questions in the list? Otmar, you have been questioned directly.
Yeah, the first question is obvious. Monetary financing, allowing the ECB doing for monetary financing would need a treaty change, but a treaty change could not be concentrated just on one issue. If once you open this Pandora box, I think the whole treaty will be at the disposition of politics, and the outcome might be rather terrible, I'm afraid. Anyway, in Germany, for a treaty change which go in the direction of a fiscal union would also even need change of the constitution for which you would need a referendum. So it's a highly complex issue. So we are between Scylla and Charybdis. On the one hand, treaty change is almost impossible to achieve, and the limits of the treaty make the life of central bank, I would say, rather easy when they observe it, difficult if they want to go around this. Second point on the Fed and inflation targeting, I'm not sure what the Fed is really doing now, because I wonder, as they explain that measurement of the output gap, etc., is impossible, how they derive their inflation forecasts in the future. So is this still inflation targeting? I'm not sure. But I think what is obvious, one needs a pragmatic approach. And in this respect, I saw always the ECB policy as much more flexible and open and pragmatic. And finally, on environment, this is a key issue. And central banks every day have to say we are fully aware of that. And they should add, unfortunately, we can do only a little about that.
Okay,
Petra?
I will go and answer the first and the last question. First one on the purchase of own debt by governments. And now interest rates are so low, it seems indeed a smart move to basically refinance your debt while rates are low. But what I actually think that countries should do is to use these unprecedentedly low interest rates, especially in the euro area, to go and borrow for investment, to build a good foundation for future recovery. And massive structural changes will be needed in many countries. So there are certain things that are definitely going to be different after the pandemic. Also, the challenges of climate change that will require massive investment to achieve a smooth transition. This is the time where you can go and issue debt and get paid for it. We have negative yields on government bonds in much of Europe. So please, take advantage of it. That would be my message to governments, to take this a once-in-a-generation opportunity to use those funds to borrow and invest in future recovery. With respect to the strategy review being too much focused on the past, so with respect to my own presentation, it was dictated by the title of the session, which was lessons from past crises. But I fully agree with your point that we should be forward-looking. But the past can provide very useful lessons. So when I look at what the Fed now has been done and the way they are now talking about their goals, that they really want to be more focused on maximizing employment in line with one of their dual mandates, I start getting very nervous because just look back what happened during the 1970s when central banks thought that they could push unemployment rates to very low levels. We don't know where the natural rate is. There's a lot of uncertainty about it. And if you try to push it too much, then suddenly you may find yourself in a situation that it's much like the great inflation of the 1970s. So I definitely think there is a risk of that, especially the way the Federal Reserve has moved right now. So there's absolutely a potential for inflation revival. And with respect to climate change, central banks will not be able to solve that problem. Governments will have to do it. But central banks can play a role in providing suitable conditions, for instance, making sure that, with respect to financial stability, that these risks are properly taken into account. And trying to stimulate lending for green investments, things like that. But it's not so much monetary policy, it's more on the financial stability and supervisory side that I think that central banks have a useful role to play, although they will not be able to solve that problem. That's predominantly something that governments have to address and have to address much more urgently.
Thank you very much. John?
Yeah, these are very important questions. I think the issues like distribution and climate change, we're all very interested in getting those right. I think monetary policy can't do everything. And that the mission creep is a problem. Petra mentioned a little bit about that, how we got away from mission creep and focused on too many things. So I would think of that as what's the best strategy for doing it? Again, central banks can't and shouldn't do everything. They have some particular roles, and they got to play those roles right. I think the question about the past is a good one. The world is always changing. The models change, but we learn so much from the past. And I think we learn from different central bank strategies. So I don't want to ignore the past. I think this setup of this session, which looked at the global financial crisis and the coronavirus together, is very important. But the way we look at the past is through models. I mean, we have models in the broadest sense of the word. You're interpreting data, thinking of what causes what. So I would not ignore those. And in fact, if you look carefully at, say, just for an example, at Jay Powell's speech in Jackson Hole, there are references in that to fairly detailed work. And so to analyze that proposal, I think it's very important to look at the models and the calculations that underlie it. You may find that it doesn't correspond. You may find it does. And if you want to think about another strategy, linked to that part, it's a way we bring the past into play through theories of causality, through monetary theories, through fiscal theories. And so that's a big part of it, which again, I'll emphasize should not be ignored in this review. It's a very important part of it. And I agree with that. Thank you.
If you allow me, one concluding word on climate change, because I share the last question. It will definitely be part of our strategic review, and this will be a significant difference with the Fed's one, for example. I think it's not mission creep. It's part already of our existing mandate, and be it as supervisors or even with the monetary head. Having said that, I agree that we cannot do it alone. Governments have to play a role. A carbon tax is probably absolutely necessary. We cannot substitute for it. So here again, I wouldn't like monetary policy to be the only game in town, but we will deal with the issue in the strategic review, promised. Having said that, we come to the end of this panel. Thank you very much to the three of you and to the floor for the excellent question. And Volker, my understanding is that we now turn to the conference warp up by my dear friend and colleague, Philip Lane. So I stop here.
Yes, thank you very much, Governor Villeroy, for chairing this panel. And thanks a lot to Otmar, to Petra, to John for participating in it. I think it was very inspiring and gave us new ideas and also how to evaluate old ideas in analysis. So thank you very much.